Hey everyone, welcome back to the channel. So Bill Ackman recently announced some major plans. He wants to fully acquire Howard Hughes Corporation and use that to create what he's calling his modern day Berkshire Hathaway. But here's the thing, when you take a look at the actual proposal, it tells a very different story to what he's saying on Twitter. In fact, I'll go as far to say that he's planning to screw over investors like you and me. The most obvious reason is that in their open letter to Howard Hughes Corporation, they're proposing a 1.5% management fee. But that's not the only reason that this is a complete stinker. And in this video, we'll go over all the ways he's trying to pull a fast one on us. And even if you're not interested in investing in this new Berkshire, stick around because understanding why this is such a bad deal and runs counter to everything Buffett has preached for the last 50 years is not only critical to understanding this deal, but it's also critical to just understanding investing writ large. Plus, I recently had some portfolio updates. I put $25,000 of my own money into a new stock, so we'll cover that at the end of this video. But first, if you like this type of content, please consider giving us a like and subscribe. It would really mean a lot to us. We're on a mission to tangibly reduce the wealth gap by creating, connecting, and equipping the next generation of intelligent investors. Helping us get that word out really would mean the world. All right, so what is Bill Ackman actually trying to do? Well, here's the background. He made this tweet earlier this week to his over 1.6 million subscribers. And he opens by saying that he discovered Buffett when he was 20 years old, and reading the letters is what inspired him to become an investor in the first place. That's awesome. And he goes on to say that when he first started investing, he dreamt of building a diversified holding company just like Berkshire. And he teases that this could be huge returns for us. He says a big part of the appeal of Berkshire is that anyone who could afford one share, about $20 back in the early 60s, could participate in the compounding of that value over time. And he further doubles down on this. He says, we will adopt similar long-term shareholder-oriented principles to Berkshire, and we intend to hold the stock forever. Oh man, this seems wonderful. I mean, I wish I had a time machine and could go back and buy Berkshire at $20 a share. I mean, it's at $725,000 a share now. But here's the thing, when you actually go into the proposal, it tells a whole different story, my friends. And in that letter, when you get past the salesmanship, you start to see that the meat of this is really stinky. He says, in consideration for services rendered, Pershing Square Holdco will receive a fee of 1.5% per annum of the equity market capitalization of the company. Wait, hold on. Of the market capitalization? Guys, that's insane. The current market capitalization is $3.7 billion. If he actually reaches the market capitalization of Berkshire off of this, which is $1 trillion, that means he'd be making $1.5 billion a year just in fees off of this. And it is very hard to compound value when you have that type of friction. And the worst thing is he knows it. That math doesn't math, Bill, and you know it. This is a shameless money grab using your extremely large following and celebrity to try to solicit individual investors who don't know better. All right, I'm being harsh. What's his defense? Well, I listened in on a Twitter space that he hosted yesterday, and he tried to defend it by saying that his company, Pershing Square, is investing $900 million into the company, so they need to get some sort of benefit. Okay, well, first, that's not what Buffett did when he bought Berkshire. When Buffett closed his partnership, he had 3 recommendations that he made to his existing shareholders. He would either return the money to them, let them continue to invest in Berkshire, or he recommended that they join a different fund, and that fund was actually Oaktree, which is run by Howard Marks. I could forgive that 1.5% management fee if, I don't know, he capped it at 150% of the upside. I mean, if he needs to justify this acquisition to existing shareholders in Pershing Square, then sure, whatever. But he's not, and I know why. He's trying to make money off of us. This is utter bullshit. He's trying to apply a hedge fund model to Berkshire Hathaway, and that doesn't work. And the dissimilarities don't stop there, but I want to take a second to show you how toxic management fees are. And to truly understand that, you have to go back to the most important thing in investing, understanding compound interest. And to show that, we'll model out what it would look like if you took $10,000 into Berkshire Hathaway and you let it grow for 50 years. And Buffett has been able to compound that at 20%. Well, that $10,000 today would be worth $91 million. That is the power of compound interest. That is why it's such a big deal, and it's so fundamental to understanding how you will grow your wealth over time. I've been seriously investing for about 13 years now, and I'm already starting to feel the power of compound interest. But what would have happened if Warren Buffett would have given us a 1.5% management fee on top of this? Our returns would have got cut in half, guys. We would have had $48 million. And he knows this. That is what really, really bugs me about this. I'm going to play a clip that shows you what Buffett thinks about management fees. But before I do that, I actually did tell a little bit of a lie at the top. Buffett actually did charge a management fee when he ran the Buffett partnership before Berkshire Hathaway. But he had a really creative fee structure. He had a 6% hurdle, and after that, he would get 25% of the profit. So if his fund returned 5% in a year, he'd make $0. And if the fund returned, say, 18% in a year, he'd get 3%. That is a wonderful incentive. But when he bought Berkshire Hathaway in 1965, he removed all of his management fees. He wanted to make money with his shareholders, not from them, which is exactly what Bill's doing. Here's Buffett on his original management fees.
Mr. Buffett and Mr. Munger, I have a thank you and a question for you. Thank you for allowing us shareholders to invest with you on equal terms, with almost no management fee and no performance fee. Now my question. Back in the 1950s and 1960s, when you had a partnership, Mr. Buffett, you asked for and got a performance fee of 25% of what was earned above 6% a year.
Correct.
What caused you to switch from that performance fee to that no fees we are enjoying today? Was it the wisdom that to give is better than to receive?
Try again.
And do you feel that this switch from performance fee to no performance fee, that is fully appreciated? And what did it mean to you personally?
Well, I appreciate what you had to say, and I would pay to have this job I have. I would pay a lot of money, and I hope I don't get tested on that. But it's why in the world, if I can work with people I like and get the same result they have and end up with all kinds of money, why do I need to make some further override on them? I was changing my position in life significantly when I started that partnership in 1956. A couple of the people that, well, I guess, yeah, Doris may be the only original partner here, but Doris, would you stand up? She joined on May 5th, 1956, wherever she is. And those people gave me their money, but I needed some money then too. And I did get an override, which I thought was fair. I got no management fee at all, though. I never charged. Today, most of the people run hedge funds charge 1% a year and then some percentage of profits. I did not do that. And I did have all my money in after 1962, so that the downside would be equal to the upside. But I've always felt about the people as partners. And when we got into Berkshire, Berkshire was owned by the partnership. So if I'd taken a salary then, I would have been double dipping, in effect, by getting money out of Berkshire before, in turn, the partnership participated. And frankly, by the time I was running Berkshire, I had all the money I needed. And I'd rather get the same result as my partners than have me get a different result. And it can't make any difference. I mean, it'll make a difference in the size of my foundation someday, perhaps, but so what? I like living the way I live.
If you listened closely in that clip, there was also another big difference between Ackman and Buffett. When Buffett bought Berkshire, he moved almost all of his net worth into Berkshire Hathaway, like over 90%, and today it's over 99% of where his wealth lies. And Ackman has no plans on doing this. He's actually keeping the company completely separate. He'll still maintain Pershing Square Holdco, and then he'll also have Howard Hughes Corp. So just like Buffett said he'd feel bad for double dipping, Bill Ackman's like, hell yeah, let's double dip. Let's take these suckers behind the woodshed. So not only is he double dipping off of us, because he's going to get fees from Pershing Square and he's going to get the fees from Howard Hughes, but also his logic just straight up doesn't make sense here. Buffett has said time and time again that buying Berkshire Hathaway was a colossal mistake. If you go to their website, you can find this article called Berkshire Past, Present, and Future, which came out in 2014. He straight up says buying Berkshire Hathaway was a monumentally stupid decision. And Howard Hughes Corp is down almost 40% in the last 5 years, so it's also not doing well. So why on earth would Bill Ackman be repeating a colossally stupid idea? All of these reasons really bug me, but the biggest one of all is that Ackman, for the reasons we just stated above, will win in any situation in which the stock performs. It doesn't matter if he's successful, he'll still profit. We'll just be left holding the bag like we always are. And this is not how Buffett did it. He treated and still treats his investors with respect and like their family. Here's longtime partner Charlie Munger on the early days of Berkshire.
He came out of a private partnership where people he knew were trusting him. And he had his relatives in the partnership, and they were not rich. And As it got bigger, started treating everybody else the way he treated his relatives.
In terms of our feeling toward the people who are shareholders, we regard them as our partners. They're not some faceless group of people. And that's why at the annual meeting, I love seeing 40,000 of them. It gives real meaning to what we're doing every day.
This messes with me a lot because I use Buffett's name a lot in the platform I'm trying to build. And that platform is all about getting everyday people like you and me to learn how to do this stuff ourselves. And it really bugs me that Bill Ackman, which is an investor that I really admire, is doing the opposite of what Buffett did, but he's trying to slap the Buffett sticker on it. Instead, he's taking advantage of our ignorance, and he's acting more like a hedge fund and a greedy investment advisor than Warren Buffett. Here's Charlie once again, and in this clip, he's talking about investment bankers, but you can get the idea.
Warren reminds me, once I asked a man who just left a large investment bank, and I said, "How does your firm make its money?" He said, "Off the top, off the bottom, off both sides, and in the middle."
I know which firm he's talking about, too.
That's not our culture, and a lot of you have been here so long, you can see that's not our culture, but in the end, it may be that Omaha will do better than Wall Street.
So instead of just talking about problems, let's talk about solutions. What should Ackman do if he wanted to actually become the next Berkshire Hathaway? Well, first off, take that $900 million that you're using to buy Howard Hughes and underwrite it yourself. And then give the same three options to your existing investors. Either return the money, recommend them to go to another fund, or let them continue to invest in Howard Hughes. And then put 90+% of your net worth into this company. If you're gonna use the Buffett name, then you gotta act like Buffett. And to my other fellow investors, don't fall for this guys. I don't care if the stock does well. 1.5% off of market capitalization is highway robbery. Okay, that was a lot. Let's cover some quick portfolio updates. Okay, I ended up selling some Lululemon stock. I'm pretty happy with my return, about 26%. And the reason why I sold is the company just isn't delivering what I thought it could deliver. CEO Calvin McDonald isn't really embracing the brand in the way that I thought he would. And it does make sense when I look at it back in retrospect. He's coming from being the CEO of Sephora, and he's treating the brand more like a retailer, and it's just not the direction that I want the company to go. I am holding almost $8,000 still in the stock because I do think their Q4 earnings are going to be really good, but I am looking to continue to sell out of the position. But then I took a new position. I put almost $20,000 into Nike. And there's a bunch of reasons why, and we've covered it in earlier videos on this channel. But the biggest thing that got me really excited is that the new CEO, Elliott Hill, is delivering on exactly what he said his plan was going to be. One of the major focuses for growth that he was focusing on was brand partnerships. And he's delivering that. The company just announced a partnership with Kim Kardashian. And this is exactly the type of refresh that that brand needs. And then I put about $60,000 more into short-term government bonds. And I'm going to continue to buy bonds. I have about $400,000 in a high-yield savings account, but M1's interest rate in that high-yield savings account is starting to fall. And right now I can almost get 1 point higher in interest rates from short-term government bonds than I can from this high-yield savings account. So I'm going to do a switcheroo and put more money into this account. I wrote up my whole thesis on Nike on flankinvesting.com. If you want to read it, you can go check it out there. I'm also discussing it pretty actively in our Discord, which is free. So feel free to come in there and ask some questions. I'd love to see you there. All right, guys, that's all for this one. Thanks so much for watching, and we'll see you in the next one.